Hey guys, welcome to another video. It's Hassy Trades here, and in this video I will analyze the key steps to avoiding a false breakout in order to help you minimize your loser and maximize your gains. So let's get right into this video, guys. So first I want to start off by saying the first step for anything when trading a stock is to understand market phases, and this is according to the Elliott wave theory, which you guys can research up on Google, or if you need any more examples, I'm willing to do another video on. Just let me know in the comments below, hit the subscribe button and like this video. But let's just get right into this. So Elliott wave theory believes we move in 5 different phases, and you got this. I'll show you examples, great examples. That's phase 1, phase 2, phase 3, that's phase 3, that's your phase 4, that's your phase 5, and then you get another phase here. So 1, 2, 3, 4, and then one more phase. Let's do the other phase. Let's just correct this line a bit. But according to him, we move in 5 different phases, which helps us build that confidence in buying and selling stocks, because when it does move in these phases, we do create an area of support and resistance, as I'll show you here. So guys, if you look here with this horizontal line, that's an area of support. Then another area of support here, that's 2, 3, 4. So every time we got a push, we did get another area of support, meaning that every time you could have purchased this on a pullback, which is so key to understand. And mixing in, now I'm going to start mixing in another theory used by Wyckoff, accumulation and distribution phases. So he had another model which he spoke about how the market also has the accumulation phase, the distribution phase, and I'll tell you why this is so key to understand, but in just a moment. So with him, his theory, he believes that the market has different cycles. So we have our initial accumulation cycle, which I'll give you a great example of. So if you look here, guys, let's just get out to this trend line. So here it is, you get this accumulation built up. So you get this accumulation phase. So we're just accumulating here, and then you get a markup, and a markup is that you get a big pole, and then you get let's now move into Elliott wave. So you get phase 1, phase 2. Let's just say this example, you get your 3 phases, and then you get your distribution phase according to Wyckoff. And this is so key to understand, and I'll analyze why. But look, the reason why this is so essential is because if you look here, guys, we get your distribution phase, we get that spring, then we get your distribution, and then we move all the way back down, mark down. Let's just start from here. So look, you get your distribution. There you go, you get your distribution, you get your distribution, you get your distribution. Then you get your little spring, which is a false breakout. Get distribution, and then you this, and then you do all the way here. So now we're going to the phase down theory, and bang, and then again we start accumulating again. So that's the cycles, the different cycles the market moves in, and it's so key to understand this, because this is what will help you avoid false breakouts. And you'll be like, oh, why is this though? Why will this help me avoid false breakouts? What correlation does it have? The correlation it has is knowing when the market will and will not give you a pullback, because there's a lot of times where you just think the market just goes in one direction, and that's to the upside. You don't ever think about the pullback and areas of support and resistance, which is a mistake a lot of us guys make. I used to make this mistake. Everyone used to make this mistake. As a beginner, you make this mistake. You tend to make this mistake, and I'll give you a great example of when you can and when you shouldn't buy. So let's just look at the chart on AMD, but I'll show you an example of these different phases using this chart. So look, so you had your accumulation phase here, just here. So you had a bit of accumulation here, probably not the strongest, but we had accumulation. If you zoom out the chart, we could see why in this area, previous area of accumulation as well. So there's a bit of a pattern there forming, and then look, that's your phase 1. What happens, guys? What happens? You get your pullback. You always get that pullback. What mistake would you guys make? And you guys will, what you try doing is, yeah, you guys will try playing this breakout. You try playing a breakout here, and you'll be like, okay, this is moving up, let's play this breakout. And you'd get an entry where the red candle hasn't even closed above an area of strength. Like this candle hasn't even closed above. So let's just look here. So you get that push, you get that push. The candle, it's a red candle. We haven't really closed above. 1 second here. Just give it here. So look, you get that red candle there. You guys will enter here. This is where shorts would smack, move to the downside, and you'll get a candle where the red candle hasn't closed above, so we don't have that confirmation, which is key to understand. So waiting for a candle close above this area will be key to entry if you wanted entry on a breakout. But what you guys don't understand is you'll always get that pullback. So if you don't get this break with a candle close above, you'll always get that breakout. And I'd highlight the main difference here, which you guys are probably seeing right now. So then we get phase 2, and that phase 2 gives us that run. And what happens here? We get that green candle close. So we push back down into an area, made higher lows. Again, another bullish thing to consider. Made higher lows, and we close this green candle above, which I'll show you, which I'll highlight for you guys. There you go. So just here, you got that green candle close above. That could be your sign for a long entry, and as soon as you enter that long position, you could get a nice move out of this. So let's just see. So you could keep your stop under here. So that's like a 1.1% stop, and you could aim for like 2R, 1R. So you can aim for like this area here. So you could aim for, actually aim for like an area. So let's just say you're risking, I don't know. Oh, so this is a higher cap, but let's say you're risking your 0.7%, and you could end up aiming for 3% plus, which is good because your your area of risk is so small, and your area of gain is big. Again, if the amount you were risking is you're risking $750 to make 2,000, so it's quite good in that sense. Even if you want to, you could even keep your stop loss even smaller. You keep it even smaller. You could keep it as small as you want, because you even keep it just below this red candle, which I normally do. So you're not risking that much. You're risking even less, and your risk to reward becomes even higher. So that is key to understand, guys. Always wait for that green candle to close above, because that's the difference between losing out on a trade and making a trade. And let's give you more examples, guys. So we look here, guys. This rectangle. So look, and this is the difference, guys. And it's so visible to you guys. So this is your area of distribution. And a lot of guys make this mistake is when once we get that push, you guys enter. You guys would enter on this green candle. We get all the way that push down, and then we get that push up. Would I enter here, guys? Why wouldn't I enter here? Guys, pop it down in the comments below, and then come back to this video in the next 5 seconds and tell me why I'm not going to enter on this red candle. 5, 4, 3, 2, 1. The reason why is because we don't have that green candle close above. We don't have any bullish candle signifying that we get a close above. If anything, this is a great signal for a short position. Why? We get that rejection, we get a push down, and then we get a green candle or even a red candle close below an area of distribution, area of supply. And this is a great short back towards this area. Again, this area becomes an area of accumulation. Why does it become an area of accumulation? Again, look at this area here. Previously, we had this area act as accumulation. Again, repeating the same step. We look for that. Do I enter here? No, I don't enter here. I watch for a markup using the Elliott wave theory. Then I look for pullback, confirmation, and then I enter. Instead of entering here, I'd prefer my entry here, because that way I'm risking even less. And let's just move it down. Let's say I did get my entry here. Let's say I got my entry here. I'm risking here. My entry is just here. That is even better. Look, I'm barely risking anything. Look, and I could even target, my first target could be here, and my second target could be here, and then my third target could be all the way up here. See, guys, risking what, 0.18%. And again, if you look at that, that's a 3 candle pattern. I think there's a morning star pattern just there formed, if you look here, guys. So that gives us more confluence. Again, it's really that simple, guys. Do you guys see where I'm coming from? Because us lot make that mistake of forcing a play, rushing into a play. I'll give you a few more examples. Let me just find a few more examples. But we got another example here. Again, we get that phase. Of course, we had a bit of a gap up. I think this is because we're not in after hours, so it shows these little gaps. As a trader, you're probably like, okay, let's get this push higher. This is looking really good. The sign of strength. 2 big green candles. Let's enter. You'd enter here. Why would you enter here? Again, there is no confirmation, there is no pullback, there's nothing's telling us where this should be an entry. It's just a big green candle with a big green wick. So what you want to do is you want to wait for that 5-minute candle to close above. And let's just move to a higher time frame to like go a bit more of a areas of supply and demand. Again, look, it's quite visible here. Again, I'll show you guys. Of course, this has been in a downtrend for quite a bit now, due to market conditions. But again, you got another area here, just here. This is your area. You probably think, oh, okay, this is accumulating. Let's look for a long entry. You get that big spike up. There is not one candle that has closed above. Just give me 1 second. There is not one candle that has closed above this area of distribution, or this area of accumulation, or this area of potential demand to tell us that we are in a long position. However, there isn't. It is telling us that we are in a short position because we did get a green candle close below, so it would be a good short position. But obviously, when we look at the upside, where we're looking for uptrend, it wouldn't be a good long position. So that's key to understand, guys. I hope you guys understood this side of this, of the charts and this side. And another step is, like I mentioned, is make sure you get used to those pullbacks. So use these theories to make you understand the concept of a pullback and how the market will always correct itself. And I'll show you an example on another chart because I like to show you better odds and show you more analysis on different charts to show you that we always get the area of pullback. So yeah, let's just show you this. So guys, if you look here, we get our push up, so our markup, and we get our pullback. We always got the pullback. We made a higher low. Let's highlight this, just here. Just a higher low just here. And what else? We held this area of demand. We made an area of demand here. We held it. Of course, we'll have more candles there. Obviously, this is the after hours off. Let's look here. So again, like I said, guys, so this is the better chart for you guys. So we got our markup. So we've got our accumulation phase here going on. So let's just mark that. We had a bit of accumulation going on. The water enter straight away. No, we got that markup all the way to this area. We got a markup, a bigger markup than expected. Again, if you look here, guys, this is the previous area of supply, now turned demand. Then we got this markdown showing, and what happened? We got a green candle close above. After having the markdown, bang, pushed straight back up. And now I'll show you the mistake a lot of traders will make. So while I've entered there, I've got my first phase, got my second phase. Wait 1 second. And then we had more phases below, but let's just say there, bang. And what they do is we'll get that pullback. They'd enter on this big red candle first of all, and look, if they are breakout traders, the mistake they make is, it was there. Look at that green candle. That green candle showed our wick, showing there is buy side liquidity. However, there is no green candle close above to indicate a move or a sign of strength hasn't been shown to show a move back to the upside. Instead, we closed back below an area of distribution. Not only that, we made a double top, again a bearish technical chart pattern showing, and then we had the big red candle again. So it's key to understand the market doesn't move in phases. The best phase is phase 1 pullback. As we move on, it gets weaker, weaker, and weaker. So the first phase pullback is the best pullback you get. So that's the key to understand. Obviously this is another recommendation for you. Always wait for signs of strength, such as your dip zones here. Let's just highlight this. Such as your dip zones. So you get that's your dip zones. You also want to wait for higher lows. So you get your higher lows. Again, this is your high. This is a higher low. This is a higher low as well. Obviously, this is made that gave us that signal to give a higher low. And look for chart patterns such as, look, if you were long here, you wouldn't want to be long because it's a double top. So take that into consideration. Wait for so obviously if you do end up entering, it leads to more foam actually making money in a trade, and it leads to a lot more panic buying in the future, because obviously you're not sticking to a plan, and it doesn't help your thesis in the long run. And another key factor which can help you a lot, guys, is look for your higher time frames. And the reason why I say this is because it will help you in the long run, and the reason is you'd get to spot major levels of resistance and support. So I'll just give you an example. So this is actually a perfect example. Thank you very much, chart, for showing me this. But let's look here, guys. This is an area of previous accumulation. Again, you could consider this to be an area of demand. However, as we get that pullback and we reject, this becomes an area of supply as well as resistance. So now this has become a major level of resistance. And if you look at the price action after this, we get that markdown. Again, now we're using Wyckoff, who considers them. Look, we get that markdown. Okay, trend line. Trend line doesn't want to work. Trend line is against us, guys. Why is this trend line not working, guys? Okay, the trend line doesn't work. Let's just use this trend line. I think I'm limited drawings. That's why, guys. But look, you get that markdown phase 1, and then you get another markup just here. See that, guys? So that's your bearish markdown, and then bang, you get a double top. You push all the way back down. So why is this key? It's key to understand this is a major level on a higher time frame, on the 1 hour time frame. And again, this will come into play in the future. Of course, on Tesla, it will, the 260 area. Let's see if it already has it. I don't think it's gone up again because of current market conditions. But it's key to understand these major levels for the future. Let's look at the 4 hour. But even if we look at the 4 hour, yeah, this becomes a major area. Again, here it's accumulation. Again, guys, look. When I mentioned this area of resistance, look at this major level on the 4 hour. Bang. See, guys? So this area has previously been tested and rejected. That was key to understand. And key to take profits in this zone. Another recommendation I give you guys is stop chasing your parabolic moves. Let's give you an example on TBLT, which is a stock we played last week for a nice move. I think we played for a 30% move. So it's quite nice. But I want you to stop chasing for those parabolic moves. So you look here, guys. You get an insane move all the way to the upside. A lot of traders, a lot of you guys, what you do is, and you guys know this, you'll see that first wave and you'll be scared to enter. You'll see that second one, you'll be even more scared to enter. Then you'll see a third move and you'll be like, okay, let me enter. By that time, this stock has already done, and let's just check our percentage gains. Where's the measuring? This stock has done approximately 56%. And you end up entering and you get pushed all the way back down to here. And you're down around, I don't know, 10-20% or so. So it's key to understand this. To know your areas of accumulation, distribution, and knowing when to enter and not to enter a stock. So don't enter. If a stock is up 100% and it hasn't had a pullback, or if it's up 50%, hasn't had a pullback, I do not recommend entering. I recommend waiting, being patient, and waiting for your areas of demand. So as you can see here, we did get pullbacks within the stock. Again, an ascending triangle just here. So we got this ascending triangle, and then we push up quite nice. So look here, get this ascending triangle, and we get that push all the way to the upside. Not only that, we get another pullback here. Again, another phase, another pullback, down descending triangle pullback. So it's key to understand this is to be patient and wait. But yeah, those are your different steps on how to avoid false breakouts. So as I said, make sure you understand market phases. Wait for a candle close above bullish, above areas of distribution, above areas of supply. Wait for that candle close above resistance instead of waiting for a wick. So with the bullish candle stick patterns, get used to waiting for market pullbacks. Wait for signs of strength such as dip zones, higher lows, candlestick formations. And then another step, make sure you look at higher time frames and stop chasing parabolic moves. I hope you guys enjoyed this video. It was a great video on educating you about how to avoid these little mistakes which you make in your trading on a daily basis. Thank you for joining, and I'll catch you guys in the next video. Let's have a great week this coming week. We got a Thursday off. I'm gonna take Friday off, and I'm gonna have a nice 4 days. But both that Monday, Tuesday, Wednesday, we're gonna make money in the market. Let's get it, guys. Thank you. Have a great rest of your weekend. Peace out.